started with the meeting. Once again, thank you, Panna, for joining us, and thank you all for joining us. We'll give a quick brief about what BEA does, um, after which Speaker Series India at Berkeley will give a quick brief about what they do. BEA, we are the Behavioral Econ Association at Berkeley. We teach the hypothesis-based approach. We conduct research for clients. We have an experiment design workshop, which is kind of like a Shark Tank, except you're pitching a research proposal instead. And we also have speaker sessions from industry veterans and professors. We had the opportunity to host Professor Stefano Della last time, who's one of the biggest thinkers in the field, and Panna Bhandari this time, who is a founder of one of the top hedge funds. Arav, do you want to give a quick brief about Speaker Series?
Yeah, thanks, Manish. My name is Arav, and I'm the president of Speaker Series India at Berkeley. We're an organization that strives to promote discussion about issues pertaining to India. We have had engaging conversations with people from the world of politics, sports, entertainment, and business, to name a few. And today we're here with Panna, who has great expertise in the field of finance. So I'm personally super excited for this and looking forward to the event. Over to Manish.
Thank you, Arav. Quick flow of events. We'll start off with an introduction. I have a few questions for Panna. I'm very excited to hear from her too. After which I'll give the floor to Arav, who has a few questions prepared for her. We'll leave 15 to 20 minutes towards the end to leave the floor open to any questions you all might have or anyone on the Zoom might have. So, quick brief about Panna's background. She has completed her BBA from Ahmedabad University and MSc in Finance and Accounting from King's. So a diverse academic background. And then she went on to work at KPMG, Mudra Group, and now is the founder and director of Emerald Investments in India. I know that my introduction wouldn't do justice to you, so I would like to hear from you, your journey beyond university, and if you had anything to add that I missed, please. Panna.
Thank you so much, Manish, for having me. And I'm actually super excited to be here. I'm just going to talk very, very little about what I do, like my journey, and then dive straight into the macroeconomic landscape and talk to you about how you can get started with a career in investment management. I'm basically a certified financial planner, and I help high net worth individuals manage their family and corporate wealth. So, Manish mentioned about my education. I was a gold medalist from HL College of Commerce, and I got my master's from King's College London in finance and accounting. We help, I started this firm when I was 21. We help about 200 different clients invest about 50 million US dollars across different assets. I got into finance because money for me is absolutely fun. I love it. I absolutely love earning it, saving it, investing it, spending it. I think my only goal as an 8-year-old was to trick my elder sister into giving me some money. And I think at 29, that's not really changed. But it's the reason I love finance is because it's truly the only career in the world that connects every field that exists. I mean, if you anything that you can think of under the sun is connected with the money that we move around. So if you talk about central banks, politics, businesses, market trends, social media trends, health, I mean, like look at COVID and everything that it did to the economic world. And even things like, our living standards or wealth distribution, the happiness index. I mean, Norway is one of the happiest countries in the world, and it is because the people are doing really well financially as well. If you look at crime rates or history or war and even religion, I mean, Vatican and some of the religious institutes are some of the largest investors in the world, right? So my job is basically as a financial planner is to understand and cover all assets. Okay, so it basically, you can boil down my job into three questions that I answer on a daily basis: what to buy, when to buy, how much to buy, when to review it, and when to sell. So those are more of ancillary decisions as to when we will review it and when we will sell it. But the three main questions are: what am I going to buy, when am I going to buy it, and how much am I going to buy of it, right? So these are three simple questions, but then it takes us into this whole crazy field of finance. And I think uh, it's the most exciting field to be in. The main assets that exist in the world, the only reason I'm talking about them is so that you kind of get an idea of what we are covering today. Are equities, bonds, real estate, commodities. That includes gold, silver, and copper, everything, and alternatives and crypto. So for somebody, even a Rolex can be an investment, or even sneakers can be, and of course, crypto you can't ignore. So when I do, so my job basically, like I said, is about asset allocation. Okay. So I'm deciding today based on how the economics and the macros are in the world, about how much money I want to invest in a risky asset versus how much money I want to put in a safer asset, like bonds. And I'm trying to gauge whether I want to invest this money for my clients in the US or in a country like India, or perhaps China, or even Indonesia. Okay. Once I select the country, suppose I've selected the US or India, for example, I decide whether I want to invest it directly in stocks, or whether I want to do it through a hedge fund, or whether I want to do it through a mutual fund, or whether I want to simply do it by a passive index fund. Okay. So these are just instruments. I'm not getting into the details because I have a lot to cover. So that's fine. But just trying to walk you through my thought process about what I do daily in my job. Um, Once I've selected, okay, I want to invest in the US, I want to invest through a mutual fund, I decide what category or what sector I want to invest in. Okay, so it basically can be I'm either investing in tech, or I'm investing in only large caps, or I'm investing only in the Russell 2000, which is covering like small caps, or I'm investing in growth stocks or value stocks. So that so basically category selection and sector selection is what comes next. Once I've done that, I will select what uh, fund I want to invest in. So if I'm doing direct stocks, that's a different thing. But if I'm selecting an instrument, then I need to select whether I'm going to invest through Berkshire, or I'm going to invest through JP Morgan, or I'm going to invest through BlackRock. So once that's done, once the asset allocation is set, the country is set, the instrument is set, the category is set, then I go ahead and make the investments. Once the investment has been made, over a period of, depending on how long I've invested it for, or depending on the market conditions, I will decide when I'm going to review it. Typically, a client review generally entails like a quarterly review is sufficient, unless it's a very, very active or volatile investment. And of course, 50% of the decision is buying, but 50% of the decision is also selling, which is very rarely spoken about. But I do believe that once a investment has run its course, you kind of should take the profits and exit. Yes, investors like Warren Buffett have a mindset of you buy and hold for the rest of your life, even if you're buying it for, let's say, 5 years, 7 years, 10 years. But at the 10-year period, if a sector or a stock has run its course, I do believe in selling it and moving on. So that's about selling. I think that takes care of rebalancing. Yeah, so that's what I do. My job is to stay on top of these 5 questions every day, and that's it. So I'm going to talk to you about the current macroeconomic environment. I think it would be interesting to cover, like, what's happening with the world markets right now and the whole macroeconomic landscape. So I've pulled out some data on GDP and the major global stock indexes, and what the central banks are doing, and what is happening with the interest rates and the currency and a little bit of Bitcoin. It's my favorite asset, even though it's crashed 10% while I was sleeping last night. Um, so let's cover GDP. So these are the largest countries in terms of the gross domestic product in 2021. So the major five ones are United States, China, Japan, Germany, United Kingdom, and India. The reason I pulled out the 2021 graph and compared it with 2022 is just to point out that India actually took over the United Kingdom this year. And it's amazing to see like a developing country overtake UK. Like it's phenomenal what India is doing. I'm going to talk about the stock. I'll show you the how the stock market in India is doing, and you'll kind of understand why this is happening. So um, let's look at the S&P 500. So what I've done is I've taken the major stock markets of all these countries of about the first five, I think, first 4 or 5, to kind of give you an idea of what's happening in the world. And Manish, if you have any question at any point, like if anybody has a question, please feel free to stop me and ask me there, because I wouldn't want to, like, have a question just dragging on till the end. Like, I don't want to lose someone in the middle. Okay.
100%. And
Um.
virtually, if you have
Yeah.
a question, raise your hand or unmute yourself and ask a question. Feel free
Yeah.
to.
Please.
This is exactly the direction I wanted to hear about macroeconomic conditions. We're all scared for a recession. The job market isn't great. We're graduating soon. So I'm curious to hear
I
actually.
I don't think you should be scared of a recession, because I think it's already here. If you survive today, I think you're going to survive tomorrow as well.
That is very
So let's look at the US. Okay. Typically, I don't know if is the graph clear enough, Manish?
Yes, I can see
Okay.
the graph. The numbers aren't too visible. Are they visible at the back? Or are they visible? Okay.
Okay.
So
Anyways, it's going to be fine. I'm going to just walk you through it anyways. So if you look at the timeline here, in 1999, when we had the first massive global correction, this was like the tech bubble, and the S&P, like the broader market of the US, corrected about 47%. When a broader market correction of 47% occurs, stocks actually correct all the way up to 80-90%. That's crazy. So if you have $100 invested at these levels, you end up with virtually like $10. That's that's painful when you do it with real money. Um, in 2008, when we had the tech bubble, uh, um, that led to a correction of 52%. And then we had this massive rally because of central banks having quantitative easing, where they pumped in money and like basically artificially created money and just bailed out banks. And then you had this massive rally all the way up till 2020, where you had the COVID crash. So about 20% correction here. And then we had another quantitative easing by the central banks, and we're going to see the quantum of quantitative easing that the Fed took to support this rise in stocks. So what happens is, when the central banks, suppose there is only $100 in the economy today, okay? Now the central bank and COVID hits, and all the businesses are kind of almost at a standstill, and they're probably considering laying off people. But what the Fed does is that, don't lay off people, please continue your business. We're going to pump in money. So they go ahead and say, okay, I'm going to put in, suppose let's say they were $100 in the economy. I'm going to, like, out of thin air, create $20 and put in the economy. That's what quantitative easing is, right? So when they put this 20 into the economy, the quantum of goods or stocks or assets in the world did not change. It was still the same. It was X. But now there is 100 plus 20 chasing this X. So what happens is there's inflation in the economy. So inflation happens not just in terms of the goods and services that you're paying for, but it also happens in asset prices. So basically what happened was Fed pumped in all this money into the economy, and the economy went crazy. It was like a market on steroids, and so stock prices went crazy, and we had this massive rally from COVID times in 2020 till 2022. Okay, so what happened in 2022 that the market started correcting? The Fed said that okay, we've pumped in enough economy money into the economy, and the businesses are running sustainably. The economies are opening up. Now you guys have to go and take care of yourself. We are not going to give you any free money now. uh, as soon as the Fed said that, it started increasing interest rates. When the interest rates start going up, basically, if I'm a business owner, I was essentially borrowing at zero interest rates from the central bank about 1 year ago. Now the central bank is telling me I need to pay 2% for it. So any business that I run needs to not only make profits, but also make profits enough that I can pay back my loan to the central bank with interest on it. So that's when the stock market started sliding. We've already seen a slide of 25%. And considering that the central bank has kind of now run out of ammunition, so now it cannot come and say, like, I'm going to pump in more money into the economy, because basically you're devaluing the currency every time you do that. Um, so now they've run out of ammunition, and we've already seen a 25% correction in the S&P broader market. A 25% correction in the broader market, it basically means like a 50-60% kind of correction across different stocks. So that's massive. Okay. I'm just going to run over the other stock indexes in the world. This is NASDAQ. So I think tech is one of the worst hit. And it's understandable, because if you see, tech was what did phenomenally well since 2008 to 2022. Like, it's been the best performing sector. So all major money making stocks have been in the tech sector. But every 10 years or 12 years, you will see a change in the sector when it comes to investing. Like, I mean, that's what I've learned in my career, that you will see sector rotation happen. And I think tech has already played out its best years. And even though Manish and I don't agree that Apple can go through a painful period, but I think Apple is going to go through a seriously painful period. I mean, if you look at all the FANG stocks, other than Apple, everything is corrected more than 35%. And we are going to cover some of them at the back. So, like, I'm just going to walk you through it. But I wanted to show you NASDAQ to let you know that there is a sector rotation happening. Every time that the world economy goes through massive turmoil, I'm not talking about something like 2013 when there was taper tantrum happening. I'm not talking about something even like COVID. I'm not talking about, even COVID was a reasonably all right period, because we had the hope that central banks will step in, which they did, and they kind of did save the economy. But it's like pushing the can down the road, right? You have to ultimately face the music that you've been creating all this time. So now that we are here at the, I think this is going to be a very, very, 2022 and 23 are going to be like historic years for the world markets. Now, whenever the world markets go through such a massive turmoil, there is always sector rotation, always. So everybody talks about tech, talks about how amazing, what kind of reserves Apple has, and how it can be a country of its own, this, that, this, that. But I think you're going to see a major sector rotation. And I think we're already seeing that. If you see Berkshire Hathaway, who is more of into like value investing and not growth. Growth is like tech stocks. Value investing is more old school economy stocks like oil and gas and manufacturing and all of those stocks. Berkshire Hathaway is already doing much better than the broader markets because they invest in old economy stocks. This is Hang Seng, and the reason I'm taking the Hong Kong index instead of China is the Shanghai Composite, is because Shanghai Composite doesn't allow international investors to invest. So Hong Kong Hang Seng is the proxy for it. I want to talk about the fact that they had, oh my God, a massive 56% crash already. I mean, so this is already happening in the world as we speak, okay? I mean, these are all charts from yesterday. And if you see, basically from 2007, if you invested somewhere here, uh, uh, and if you held it for like all this while from 2007 to like 2022, which is 15 years, you've made zero returns on your money. That is, wow, that is really painful. Okay. Um, so of course there would be investors that got in 2007 and exited at 2022. But when we're talking about long-term investing, and they say just buy and hold, I don't think that works, because even after 15 years, you could be sitting at zero returns. Um, so that's that. Now we're talking about the FTSE 100. So basically the broader stock market of the United Kingdom. It's held up reasonably well. I'm happy to see that even though it fell 28%, it's kind of bounced back. But you can already see that we are facing, like, the UK economy is in a massive turmoil. We already saw like Liz Truss resign because of the mini budget that they tried to propose and clear. Like they proposed tax cuts, and it created like a major havoc in the bond market. So what they were saying is that we are going to have tax cuts. Whenever you say you are going to have a tax cut, you're saying that I'm going to basically get the money from somewhere else to support the government and the entire country. Where is that money going to come from? That money is basically going to come out of thin air, because the central bank of the Britain Central Bank is going to come and say, okay, here it is, here we are going to give you all this extra money. When they do that, the older investors who have already invested in the central bank start questioning whether, if you keep printing money, are you going to be able to sustain this, and are you going to be able to pay back the older investors? That's why the bond market went into a major havoc. And their pension fund, which basically states that everybody who's retired from a government job in the UK gets a pension. It almost reached a point of collapse where they had to say that we have to, if this budget is approved, then we will have to undertake additional borrowings just to sustain the pension, which is like a massive, like, it's like a point of no return, right? If you're going to just take loans to sustain paying out pension, that is crazy. And we're talking about a major developed economy. I'm not even talking about an economy like Turkey or Croatia. We're talking about the UK. But this is how but in my opinion, the US and the UK and the Europe in general, because of the war with Russia and Ukraine, are going to see a massive turmoil, just like in general. But this is how cycles change over time. When I said, when markets correct like 35, 40, 50%, you always see sector rotation. When you see sector rotation, and when I see, okay, tech is not gonna be as lucrative, and that's not where my money is going to be invested, but it's going to go into old economy stocks, like something that I think kids of this age are not going to even be interested in hearing about, is like oil and gas and manufacturing and power and metals. But you have to see that all the tech companies actually come out of the US. And when I say the US is going to go through a turmoil and tech is going to go through a turmoil, uh, and old economy stocks come from developing countries because labor here is cheap, right? So you can have more manufacturing oriented businesses in countries like India. So when I say manufacturing is going to do well, it automatically means that countries like India are going to do well. Now, the massive advantage that India has in itself, it's not like we are great. Just the fact that China is really, like, sorry to use the word, but screwing itself up with its political environment. That's how India has a massive advantage, right? Um, and in COVID, everybody, like the world, experienced, and it created this concept where China plus one is the norm now. So if you are doing or sourcing from China, everybody says that yes, we will source from China because it's the cheapest and the most effective, and the quality will be guaranteed. But we are also going to source from another country. So that's where India kind of like had a massive advantage. Like before COVID and before this shutdown and before before China kind of unleashed its dictatorship style of doing business or closing its economy, Apple would have never considered coming to India to set up a plant, but it has now, which is great, right? Um, so then I'm going to move on to India. So in this massive turmoil, when US corrected like 25%, Nasdaq tech stocks corrected 35%, China corrected 52%. India actually is sitting on all-time highs. It's crazy for a developing country to be sitting on all-time highs when all the world markets are in massive turmoil. So let's see, in when the US markets went through a turmoil in 1999 to 2000, even India had a 45% correction. In 2008, we also had a 56% correction. In COVID, we had the similar 30% correction. And now that the US has had a 25% kind of broader market correction, India is still sitting on the top. This generally doesn't happen. So I don't want to say that that India is not going to get affected. I think at some point India will also see a crash. But what I'm trying to say is, when the sector rotation happens on, or when a country rotation happens, you see resilience in it. So when US corrects but India does not correct, what it's telling me as a financial analyst is that, okay, the next 5 years, I think India is going to do better than the US because it was more resilient in the crash than the US. And generally, the mindset is that, oh, US has corrected 25% and India is not even corrected. So why should I buy India? I should just buy the US because it's trading at a discount. But I don't think that's how it works. And I have seen it by experience that no, whatever is the most resilient in a stock, in a broader global market crash, generally does really well in the next leg of the market. So if I'm still expecting a correction. Like in 2023, I think India is also going to see a correction. But if US corrects like all the way up to like 50%, which it definitely can, uh, we would see a correction of about 25-30%. And even though that's a correction, and all it's telling me is that, okay, it's my time to buy India now. And I'm saying this uh, with a complete disclosure of that I was a massive investor in the US markets in 2014. So all this time, I have been a US market investor. But like I said, it's my job to be absolutely ruthless about what is going to make money for me and my clients, and just go where my research tells me to go, right? So I spoke about, so I just showed you the world market indexes, but I'm going to try and tell you about what kind of research that we do that tells us how things are related in the market, because we just saw standalone markets, but all of these things are obviously integrated, and they're one living, breathing organization, right? Like interest rates, inflation, currency, stock markets, bond yields, everything is kind of related, right? So I wanted to take a chart that kind of shows you how we come to conclusions about the conclusions that we come to, right? Just 1 second. Yeah. So this is the 10-year bond yields of the US versus the NASDAQ. Okay. So I'll just take a second to explain what the bond yields are. The bond yields are basically telling you, if you invest in a US bond at any point of time, uh, if you hold that bond for 10 years, what is the return on investment that you're going to get? Okay, so the dark blue line is basically the bond yields. You can see that from 1980, the bond yields have just been dropping. Okay, so the bond yields are impacted directly by what central banks are deciding to do with the interest rates. So so the Fed, I think, has about 8 meetings in a year, and the Indian central banks have a meeting every 2 months. But yeah, the Fed decides what they want to do with the interest rates. So you can see that they've been dropping interest rates all the way up till 2020. Okay, I'm sorry, that's all the way up till 2021. And Yeah. And then 21, last year, October, they started increasing the rates. Okay. And I want to show you what happens in, how does that correlate with the NASDAQ? NASDAQ, like I said, is the tech index of the US. Okay. And it was the best performing asset over 2008 to the 2021 period. So if you see the orange line, it shows you that as the bond yields were dropping from 2000 to 2021, NASDAQ had a massive, massive bull run, like crazy bull run, the best bull run, I think, across all across the world for this period. So from 2000, that's when, you know, Amazon and or Google and all these companies started coming into the limelight. And, you know, you hear of investors who have made like 20x, 30x kind of money on their stocks during this period. But what happened in 2021? The central bank started saying that we are going to increase interest rates. And they did that. You can see that the interest rates are now back to the levels of 2006, 2007, where it's the 10-year GSEC is trading at 4.2%. And at the same exact time, NASDAQ dropped. See, you see this massive, as and when the central banks are increasing their interest rates, NASDAQ is dropping. And if they continue this, NASDAQ will continue to drop for sure. So what I'm trying to tell you is that we do intermarket analysis, and we also try and connect. So why do I say that? I'm pretty sure that tech, the entire tech sector has had its run and now it's done. It's because there are so many factors, not just the 10-year GSEC from the US, but there are so many other factors that will help me establish this correlation and be sure of my decision. Okay, so this was just to give you an idea of what a research analyst will actually do in their jobs. So I
Also,
wanted to draw this. Yeah,
Panna,
yeah,
real
please.
quick, we're nearing the end, so to leave time
Okay,
for questions, if we could,
okay. How much time do we have?
about 20 minutes. So,
But that includes the questions, right?
yes.
Okay, so I'm gonna skip a few slides. Okay, this basically shows that from 2021, oil and gas and all the old economy stocks started doing well, and tech kind of started dropping. We've seen a 75% drop in Meta, and I mean, people call Bitcoin volatile, but then what is Facebook? So yes, Bitcoin has dropped 75%, but it has seen in its history, it's seen falls all the way up to 85%. So I'm not worried, even if it falls a little bit. I think Bitcoin, because of the currency issues and the fiat currency, is kind of here to stay at least for the next 3-4 years. I think it's gonna have a massive bull run going ahead. I'm gonna skip all this because I have run out of time. Clearly I did not time this well, but it's fine. I think I want to talk about investment management jobs. Okay, so basically, like there are two sides to the investment management jobs that you can have. You can have client facing roles like mine. Basically, I'm a financial analyst and a private wealth manager, so I help in asset allocation and financial planning. So, you know, like everything that I told you, I'll decide the country, I'll decide the instrument, I'll decide bonds versus equity versus real estate versus crypto, and I'll decide which fund manager I'm going to place my money with. Similarly, there are quantitative and analytical jobs. So the reason I put these two pictures, if you've ever seen The Big Short or if you've seen The Wolf of Wall Street, The Wolf of Wall Street, Leonardo was actually having a client-facing job. His job was to actually, he was selling, right? It was a sales job. And if you look at Michael J. Burry, he was having more of a behind the desk kind of a job. It has more to do with portfolio construction and investment strategy and risk management. Okay, but of course, both these jobs will have like an overlapping roles. One second. So about the overlapping roles, you do need an understanding, like an in-depth understanding of all assets, whether you are client-facing or whether you're doing a more of a research analyst job. And a research analyst job will be more closely related with things like portfolio construction. So once somebody like Panna has made an asset allocation in JP Morgan, for example, JP Morgan running an active fund is going to decide, okay, there are about like 1,000 or 2,000 or 5,000 stocks in the US markets. I'm going to narrow down and make a portfolio of 15 or 20 stocks. So that's his job then. Once I've handed over the money to JP Morgan, the research analyst or the research team at JP Morgan is going to narrow down which 15 stocks am I going to select. And that's the kind of work that they do. If you want to get into the research, portfolio construction job, then you need a degree in I would recommend you get yourself an additional degree in becoming a certified financial analyst. And if you want to do a job that's similar to mine, I think an additional degree of CFP would be more relevant. And I know that this was the part you were really looking forward to hearing. But since I've run out of time, please just write to me any questions that you might have. Okay. The types of jobs that you can get is like you can work with hedge funds, or you can work with mutual funds or brokers or investment management firms, family offices, bankers, independent advisories, mergers and acquisitions. And I know this can seem like extremely overwhelming, but I've tried to narrow it down for you. Okay. So, what I would suggest is start where you can. Any job that you can get in investment management, just take it, okay? And try and take a general investment job. Don't try and work in a very niche or very specific firm, okay? Take one step at a time and just roll with it. If you don't like it, just go on to the next one, okay? So when you know what you don't want, it's not like you've wasted your time. You've just become more clear about what you do want. So I don't think that any job you take is going to be a bad job, so don't worry about it. Just take one. uh, every individual has to make their own path, but I would say that get a job before you get a master's and an MBA, because it will really help you understand what kind of a master's or MBA you want to do. And ultimately your master's or MBA will actually help you in your job instead of being an additional just degree that you paste on your resume, right? When I did my master's, I was already working, and it really helped me during my thesis, because I chose a subject that actually helped me learn about my own work, and that was fantastic. So all the like 1 year that I spent doing my thesis, I actually applied it in my job, and that was really helpful. I would encourage all of you to, and I'm sure a lot of you already do this, open a trading account, okay? Learn to execute basic buy and sell. This really helps on a resume. So when I'm hiring, if a kid knows how to do this, half of my job is done. I don't need to teach him operations. So I really like when something like this exists on the resume. Get comfortable with indexes and stocks, which is fine. Please stay away from derivatives, okay? Stay away from derivatives and leverage for at least 8 to 9 years into your career. Even somebody like me can have a massive issue with leveraging derivatives. So please just don't do this. If there's one takeaway from this entire presentation, don't get into derivatives and leverage unless you are really into your career like 10 years down the line, okay? Okay. This is just general advice. Like, don't let industry jargon intimidate you. So if there were terms that I used that you couldn't get a hang of, just hang in there. I think finance people like to pretend that they're fancy and they talk in a language that most people wouldn't understand. But just hang in there. You'll get good at it. And the best place to start, I said, start as a research analyst for a mutual fund or for a hedge fund. Okay. So try and go from general to specific in your career, not specific to general. So if you're working in M&A, and if you're working on specific type of deals, it's going to be very difficult for you to become a research analyst. But if you're working as a research analyst who has a understanding of broader markets, it's going to be eventually easy for you to get into M&A for a specific kind of industry. Okay. Last thing, your work is actually one third of your day or of your life. Have fun, don't torture yourself. So if finance is not for you, get out of it. It should be very satisfying. Like I said, you gave me 1 hour, but I could actually talk about it for 2, 3, 4 hours if you let me, but I won't. But I find absolute satisfaction in my work, and it's tough. In the beginning, I'm not going to say that it was easy, but I knew that I enjoyed it. And because I enjoyed it, I didn't mind whatever else came with it. uh, if you want to make money, you have to be good at what you do. And if you want to be good at what you do, you have to be consistent. And if you want to be consistent, you have to have interest in the subject. I don't think I could have stuck around having 10 years of in this job if I had no interest in finance. Okay, so make sure that whatever you're doing, whichever field, whichever hedge fund, M&A, corporate strategist, or whatever you're doing, have interest in it. Only then you're going to actually make a solid career in it. Yeah, I'm done. I'm sorry, Manish, that took longer than expected.
Not at all. You
Yeah.
answered all of my questions in the process. So thank you for that.
Okay, brilliant, brilliant, brilliant.
I do have one question. So
Yes.
first of all, thank you so much for the entire presentation. This was really informative. So my
Yeah.
question is twofold. Firstly, you founded Emerald Investments right out of college. So what was the
Yes.
inspiration behind that? And secondly, Berkeley is the hub of student-built startups. Every day on Twitter, I read someone becoming a builder and all of that. So what advice would you give students who are looking to start their own company?
Okay, first question. You can you repeat the first question? I'll come to the second one.
Sure, yeah. So you started Emerald Investments right out of college. So what was your what was the inspiration behind that?
Wow. Okay, that's a personal question. So I have seen both my parents work extremely, extremely hard on building wealth. Okay, so my father ran a steel unit. He runs a steel unit, and my mother was also independently working, which um, which in India is not the norm, at least not 30 years ago. Uh, but I have not seen any of them spend even 1/10 of that time managing wealth. And I think I saw in my own personal life massive ups and downs because of personal finance not being managed properly. And that's where I think the need kicked in. And then I started doing this at 18 for my family. And I eventually started dishing out advice to a lot of my friends and like family. And then I kind of started realizing, wait, I can do this as my full-time job. And that's how I kind of started this work. I always knew that I'm going to work independently. I'm extremely poor at taking orders or direction from anybody. So I knew that I will be working independently. And I think everything kind of just blended into one decision of starting. The second question was, sorry.
Yeah, thank you. So the
I
second
have
question,
I have like the attention span of a goldfish. Like you will lose me. So
yeah,
yeah, sorry,
no
say
worries
that
at all.
again.
The second question was that Berkeley is like a hub for startups, student-built startups. So what
Correct.
advice would you give to students who are looking to start their own company?
I think somebody who's already starting their own company does not need any advice. Go ahead and do it because you are going to learn more in that process than you will ever learn in a job. And it is massive base building. So even if you go ahead and shut it, even if it fails, even if it becomes a $1 billion company, whatever it does, it's massive base building. So even if you take a job after a startup, it's amazing. And anybody who is actually running a startup or starting a business of their own, only they know what they're doing. Really, only they know what they're doing. I would say they don't need my advice. And the fact that they are starting their own company and their own startup, they don't need my advice for sure.
Definitely. Yeah. I think for the sake of time, we'll go straight into audience questions. Is that correct, Manish?
Sure.
Yes. If please raise your hand if you're on Zoom, or if you're in person, raise your hand and I'll call you out. Jack.
So my question is that you're saying that the NASDAQ tracks with the interest rate set by the Fed. But you can't possibly imagine that the Fed will keep interest rates high or keep raising them for the next 3 or 4 years. So how can you say that the NASDAQ is going to shit and the whole stock market's falling out from under it if the interest rates will eventually stabilize from the Fed?
Fair enough. Great question. So I'm not saying that the Fed is going to continue to increase interest rates. And honestly, from all the interest rate hikes that have come after, let's say, May or June, have kind of had the market kind of caught them by surprise, because the market kept assuming that, okay, this is it. The Fed cannot increase interest rates beyond this point. But well, it did. And now we are already sitting on this massive correction. I agree with you that when the central banks stop increasing interest rates, or they at least yeah, if not reduce them, just stop increasing interest rates, you will see some relief in the market. Yes, I they can all in a recession or in a flash crash, you can always have bear market rallies. And when you have to understand, when you study, and that's why I said that history really is connected with finance, because if you look at history, every sector that has done well, it has not had a run for longer than 10 or 15 years. All I'm saying, and I'm not saying that everything, all the companies in tech are going to go bust. Of course, they're going to survive. Some of them are going to survive. And after perhaps 8 or 10 years, they're going to be the new uh, tech geniuses of that era. All I'm saying is that the other sectors like oil and natural gas and metals and commodities and power are going to do much better than the NASDAQ. So I'm not saying that you're going to watch the NASDAQ go down to zero. That's impossible. Okay. All I'm saying is that you're going to continue to see a crash as long as the Fed increases interest rates. And the next decade does not belong to tech because it's already had its run.
Fair enough.
Thank you. We have time for one more question. Anyone have any questions on Zoom?
I was
Okay.
just wondering, where do we contact her if you have more questions?
Yes, that's a good question. How do they reach you? Because
I'm gonna put my email address on the chat. Yeah.
Okay, that'd be good.
And then, yeah.
Ari, I think Ari has a question.
One more question. So, you mentioned about Liz Truss's policies. So, didn't she also promise to cut spending? Why would the bond market affect it that way if they're afraid of the instability of lowering taxes when spending also cuts with it?
Because I don't think that the spending can be cut in exactly in proportion to the tax cuts that they needed. And and we skipped that slide, but I wanted to show you that the government always talks about reducing spending, but I've never seen an actual government actually do it. They never do it. Okay, so and all these correlations that I talk about, they're not exactly they don't happen on the same day or the same hour or on the same week. Okay, so there's a lag in kind of the things that happen, like the impact of the interest rates on the NASDAQ or the impact of the proposed tax cuts on the bond market. Some of them are also knee-jerk reactions. So sometimes, like for example, COVID was a knee-jerk reaction. People didn't know what's going to happen, and then they just react. Like institutions, like pension funds, for example, cannot take certain kind of risk. Their risk management team. So suppose if you become a risk analyst, we'll just tell them whatever is happening, don't think, sell it. We cannot afford this risk on the portfolio. So sometimes the market reacts just on a knee-jerk basis, but it is kind of telling you that this policy is not going to be accepted well by the market. When a knee-jerk reaction like that happens, it's also kind of giving feedback to the government that this policy is kind of not acceptable by the broader markets, which is why essentially she did have to resign.
Thank you. I think we're out of time. Thank you, Panna, for joining us. Definitely learned a lot about career, CFA, and all of that, and the market as a whole.
Thanks so much.